So what is quantitative easing exactly? To achieve the economic objectives set by central banks adjust the supply of money. A conventional method is adjusting the targeted interest rate, ultimately decreasing or increasing the cost of borrowing money. The implementation differs per central bank and has also evolved over time. The Federal Reserve, the Fed, for example, implements overnight reverse repurchase agreements alongside paying interest to financial institutions on excess reserves to influence the interest rates. When conventional methods do not achieve the desired results and the potential danger of deflation looms, central banks resort to unconventional methods to increase supply of money and stimulate the economy. One of the first ever instances of such an unconventional method was in 1932, at the peak of the Great Depression, when the Fed implemented quantitative easing. Quantitative easing, also commonly referred to as large-scale asset purchase, is a tool within the monetary policy of central banks aimed at increasing investment and spending to foster economic growth. Examples of quantitative easing practices by the Fed to increase the money supply include buying US Treasury and mortgage-backed securities with electronically created money, decreasing the supply of these securities. Now, this normally increases the demand and price of these securities, and as a result, interest rates decrease alongside the yield. With this decrease, businesses and individuals are encouraged to borrow money due to the lower interest rates, all in the hopes of fostering the economy. The Fed is currently still making purchases of around 120 billion US dollars a month. And I will add a link in the description below to the specific page of the Fed that exactly shows the latest purchase and its pace. Because maybe in a few years from now, the pace is vastly increased, or maybe the purchases have tapered down and completely stopped.